This is Tom Harden. I'm Chief Investment Officer of Canterbury Investment Management. Today is Monday, March the 16th. Last Thursday after the close, I sent a video update that explained how irrational crowd behavior can cause temporary wild swings in the market. In these cases, markets become very counterintuitive. In other words, they can change directions very quickly, and it happens when the majority would least expect. Friday was a good example. Investors were in a state of panic following Thursday's 9.5% drop. Actually, the S&P 500 had dropped 27% in just 16 days. That is the fastest and largest decline in the history of the U.S. markets. Then the seemingly impossible happened, a 9.3% advance on Friday. Today was another seemingly impossible day, and tomorrow is likely to be another. So what lessons can be learned? I'm going to start by making three important points. First one, do not focus on percentage dollar gains and losses during emotional markets. Emotional markets cause fake pricing. Let's take last week and today as an example. The daily returns from last week through today ranged anywhere from up 9% to down 12%. Bottom line, the market has no idea where it should be because it's being driven by the actions of irrational investors. Second, the current highly erratic volatility is not about the impact of the coronavirus on people or on the economy. Let me say that again. The current erratic volatility is not about the impact of the coronavirus. Instead, the irrational daily swings are caused by knee-jerk decisions being made by irrational investors acting in a herd-like mentality. They call this behavior the madness of crowds. Following the crowd encourages bad decisions. Third, don't make the fatal mistake of reducing market exposure following a volatile down leg in the markets. Sharp declines are followed by equally sharp rebounds. For example, last Friday's 9% advance. In other words, don't make bad decisions that can cause you to have more money invested from the top to the bottom and then have less money invested on the way back up. Now, I think that most would agree that the coronavirus is a short-term phenomenon. Emotional markets tend to bottom before the news is the worst. And they bottom quickly. Today looks like a capitulation day. They threw out the proverbial baby with the bathwater. The worst case scenario appears to be discounted by the market. Remember, volatility works both ways. Big declines bring big oversold rallies. Now, according to Canterbury studies, emotional sell-offs that begin with a low volatile bull market state and at a market peak like we had 17 days ago have occurred about 51 times since 1950. That's 70 years. The most volatile periods were triggered by different events, but the short-term reactions of shock and fear were also quickly replaced by an equally emotional rally and eventual resumption to a normal market environment. Right now, investors are irrational. This decline is a media-driven event that has caused a short-term panic. Events like the coronavirus tend to be short-lived, and as I said in last Thursday's video, the current market environment is the opposite of a highly emotional bubble. We all know how bubbles end. They burst, and they burst quickly. This event will end with the opposite outcome. Expect short-term panic buying that retraces about half the decline, followed by a period of stabilization as it regains its footing. I've been in the portfolio management industry for over 40 years. The last 30 of those years have been spent developing and implementing an adaptive portfolio management process called the Canterbury Portfolio Thermostat. The portfolio thermostat was built based on many studies using market data going back as far as 1896. Our process was built on scientific methods and evidence-based studies. Canterbury's process is designed to benefit from swings both up and down that follow the oversold rally. In the event that our indicators reflect a sustained bearish environment following the rally, our process will diversify to include alternative and inverse exchange traded funds, ETFs, those that benefit from a declining market. We'll keep you informed as the markets progress. I will encourage you again to watch or rewatch last Thursday's video. It'll help put the current market environment into perspective. Thank you for listening, and thank you for your confidence.